Hey everyone, welcome back. Today we are diving into a really powerful explainer. We're going to completely demystify a system that most people think is permanently locked behind multi-million-dollar hedge fund paywalls. We're literally pulling back the curtain on how artificial intelligence secretly controls the modern stock market. But more importantly, I'm going to give you a step-by-step tutorial guide on how to build your very own personal, automated AI trading system. We're democratizing Wall Street's tech today, so grab a pen and get ready to take some notes.
All right, first things first, we really need to shatter a pretty massive illusion. You know, when you picture the stock market, right? You probably imagine those chaotic trading floors in New York, human brokers screaming, waving paper slips, making split-second decisions based on pure instinct. Well, honestly, that version of finance is completely dead. It's a ghost kept alive just for the movies. The reality is that a staggering 80% of all daily global stock market volume is executed entirely by automated algorithms and neural networks, and they're doing it without a single line of human input.
So, here is our roadmap for today's explainer. First, the Wall Street illusion. Second, how institutions use AI. Then we'll cover your retail AI stack, followed by the automated stock screener, avoiding AI hallucinations, and finally, your step-by-step playbook.
All right, let's jump right into section 1, how institutions use AI.
Look, to start winning, you first have to deeply understand your competition. We need to look at exactly how institutional desks and quantitative hedge funds are actually operating today. Because, spoiler alert, they are definitely not relying on gut feelings. The old way, human intuition, drawing simple triangles on basic charting apps, is over. The new way is entirely driven by alternative data, natural language processing, and objective physical metrics. Honestly, the average retail investor sitting at home trying to compete with Wall Street using basic technical analysis, well, it's essentially like bringing a wooden stick to a laser fight. The game is just completely rigged against the emotional human trader. Let me give you a super practical example of how this alternative data actually works out in the wild. Imagine an oil company is getting ready to release its quarterly earnings. Long before that document ever hits the public SEC database, an institutional AI model is already tracking live satellite imagery of oil tankers floating out in international waters. The AI calculates their displacement depth in the water, literally how low the boats are sitting, to estimate exactly how many millions of barrels of oil are moving across the globe right that second. So, by the time the human CEO steps up to the microphone to read the financial numbers, the AI has already executed millions of shares based on cold, objective, physical data. Crazy, right?
And guys, it gets even more intense with natural language processing. The exact moment a central bank chairman begins a live press conference, thousands of custom AI bots are ingesting every single spoken word. But they aren't just reading a text transcript. They are measuring syntax patterns, analyzing the speaker's tone, and even counting microscopic pauses between words. If that AI detects just a 1% shift toward economic anxiety compared to, say, 20 years of historical speeches, it triggers an automated sell order across the entire market in under 3 milliseconds. 3 milliseconds! This whole system relies on pure speed, data monopoly, and absolutely zero human emotion.
Okay, moving on to section 2, your retail AI stack.
I know Wall Street's tech sounds super intimidating, but here's the best part. Everyday investors can now democratize this exact logic. You really don't need venture backing to do this anymore. We're going to shift from the problem to the solution and start building your system right now. Here is your practical, step-by-step tutorial for building a modular retail AI stack using a 4-layer architecture. Step 1 is data collection. You can't just use generic web searches. You need pure, unmanipulated historical pricing data. You can get this using low-cost APIs like AlphaVantage or Polygon.io. Step 2 is your analytical engine. This is where you plug in an advanced language model like Claude or ChatGPT Pro. But here's the trick. You have to write specialized instructions forcing the model to act as a quantitative accountant, analyzing things like cash flow stability and debt-to-equity ratios. Step 3 is your backtesting hub, using tools like Python or QuantConnect to verify all the math. And finally, step 4 is connecting your broker execution API. You are literally linking everyday consumer apps together to create a quantitative hedge fund setup right on your desktop.
Which brings us to section 3, the automated stock screener. So having the tools is great and all, but we absolutely need a strict filter to remove your biggest vulnerability, your own human cognitive bias and emotional errors. To put this into action, we're going to establish a multi-factor ingestion model to completely strip away market hype. You basically instruct your AI to scan the S&P 500 and apply 3 rigid filters. Filter 1, price to earnings compression. The AI instantly rejects any stock trading at an irrational valuation, just throws it right out. Filter 2, institutional accumulation. The AI scans quarterly 13F filings to verify if the smart money, hedge funds, are quietly buying up shares while the public price remains flat. Filter 3, sentiment divergence. Here, the AI flags companies where corporate fundamentals are mathematically expanding, but public media sentiment is temporarily negative just because of macroeconomic noise. What actually passes through these 3 filters is a highly refined list of fundamentally bulletproof companies that are primed for a rebound.
Next up is Section 4, avoiding AI hallucinations. Now, before you deploy a single dollar, we really need to introduce a massive structural guardrail. You've got to protect your capital from the absolute biggest hazard in financial tech right now. You need to memorize this definition. An AI hallucination happens because standard language models operate on predictive text. They don't natively understand the absolute weight of real financial capital. Think about it. If you ask an AI to calculate a net profit margin without enforcing strict mathematical constraints, it will frequently just invent random numbers. They sound completely realistic, but they are factually, mathematically wrong. Trusting unverified predictive text with your real, hard-earned capital, that leads to sudden, devastating portfolio erosion.
So how do we completely immunize ourselves against that trap? We use a historical backtesting verification blueprint. Whenever your AI suggests a strategy, you never, ever execute the trade immediately. Instead, you have the AI write a clean Python script. Then you run that script against 10 years of historical data to answer one absolutely critical question. What happens to your money during historical crashes? You literally force the AI to prove its theory against the 2008 crash, the 2020 correction, and the 2022 inflation spike. And here is your clear, non-negotiable instruction. If that backtest shows a historical drawdown of more than 15%, boom, you instantly discard the strategy. We only trust cold mathematical proof.
Finally, Section 5, your step-by-step playbook. We've covered a tremendous amount of ground today, so let's pivot to your highly actionable summary checklist. These are your immediate marching orders to get your system online. Step 1, secure clean data access APIs. It's time to stop reading generic media articles for financial moves and get straight to the raw CSV data files. Step 2, build your risk tolerance parameter matrix right inside your AI workspace. You need to explicitly define your boundaries, maximum sector exposure, strict stop-loss thresholds, and your minimum capital reserves. Establish those hard rules first. Step 3, run dual verification backtests. You can absolutely treat your AI as a hyper-efficient financial analyst, but you must act strictly as the human chief risk officer. You verify the math before a single dollar ever moves.
Look, the modern stock market is basically an arena of pure computational leverage. If you're out there trading using emotional patterns, you are honestly just funding the profits of Wall Street's server farms. But by layering clean data, custom AI context models, and objective historical backtesting, you can unlock wealth-building efficiency entirely on autopilot. So I want to leave you with this provocative thought. Are you ready to make the shift? Have you ever actually used an AI tool to help manage your portfolio? Or do you still trust your own human intuition? Drop your current strategies in the comments below. I'd absolutely love to see how you all are tackling this. Until next time, stay focused, trust the data, and keep learning.